International economics, international trade. The difference between international and domestic trade. The first one, immobility of factors of production. Laborers are free to move within the country, domestic trade, but are immobile, meaning less mobile between countries for international trade. This is due to financial constraints, language barriers, cultural differences, and the like. Second, availability of natural resources. Different countries are different gifted with production of different commodities because they have a diverse supply of productive factors. International specialization can increase world output and bring about comparative advantages. Number 3, monetary units of currencies. When trade occurs in the country, for example in Malaysia, all transactions will be in ringgit Malaysia. However, in international trade, the monetary units or currencies used are different. Generally, many countries use the United States dollar, USD, in international trade. Number 4, national policies. In domestic trade, laws and rules relating to taxation, labor standards, education, and legislation will be the same in each country. In the case of international trade, there will be vast differences in the laws of different countries. Number 5, documentation. International trade involves greater documentation compared to domestic trade. Examples of documentation that exist in international trade are import and export license, traveller checks, bills of exchange, and many more. Number 6, protectionism. Protectionism is practiced only in international trade, where many countries want to protect their local industries from foreign competition. Number 7, size of market and total transaction. In international trade, the size of the market is relatively larger than that of domestic trade. The sales volume would be higher compared to sales within a country. Advantages of international trade. The first advantage is increased world output. World output increases through specialization and international trade. Second, variety of goods and services. A variety of goods and services are made available for consumption by consumers of a country. Consumers get to enjoy some goods that cannot be produced in their own country due to geographical or other reasons. For example, Malaysia cannot produce apples and grapes. Number 3, better relationship between trading partners. The relationship between trading partners can be enhanced, for example, via trade fairs, economic cooperation like ASEAN and EU, and also cultural exchange. Number 4, higher income and economic growth. International trade can generate more income, which increases the standard of living of a country. If more goods are exported by a country, the income generated from the export can boost the country's economic growth. Last, shared knowledge and technology. International trade encourages the sharing of knowledge, information, and technology among countries. For example, if Malaysia imports new and advanced machinery from Japan, both countries can then share the technology. Next, barriers to trade or disadvantages of international trade. The first one is depletion of countries' reserve. A country will specialize in the production of goods over which it has a comparative advantage. However, continuous exports of raw materials can deplete the country's reserves in the long run. For example, excessive export of oil by Malaysia will deplete its oil reserves. Second, economic and political dependence. International trade may cause economic and political dependence between countries. This could prove disastrous, especially if the political relationship between the trading partners falls apart. Number 3, transportation cost. The assumption in comparative advantage is that no transportation costs are incurred. But if transportation costs are too high, then international trade will not be a profitable venture for some countries. Absolute advantage and comparative advantage. Absolute advantage is the ability of a country to produce more efficiently than another country. While for comparative advantage, the ability of a country to produce goods at a lower opportunity cost than another country. So for absolute advantage, we have several underlying assumptions to study. The first one, there are only two countries in the world. Second, only two goods are produced. Third, free trade exists between these two countries. Fourth, no transportation costs are involved. Fifth, production is under the law of constant cost. Sixth, identical production functions between trading countries. Okay, this is an example of absolute advantage theory. We have two countries, Malaysia and China, which will export and import two goods, cotton and also rice. From this table, both countries divided their resources equally. For instance, Malaysia uses 50% of the given resources to produce cotton and another 50% to produce rice. Thus, Malaysia can produce 20 tons of cotton and 60 tons of rice. Meanwhile, China can produce 40 tons of cotton and 20 tons of rice, with equally divided resources for the production of cotton and rice. So from the table, it can be seen that Malaysia has an absolute advantage in producing rice, while China has an absolute advantage in producing cotton. We have different table for comparative advantage theory. From the table, Malaysia can produce 60 tons of cotton and 10 tons of rice. Meanwhile, for China, China can produce 20 tons of cotton and 10 tons of rice. To determine which country is to specialize in cotton or rice, the opportunity cost of production must be calculated. The second table of comparative advantage shows how to calculate the opportunity cost for both countries. Malaysia has the lower opportunity cost. It is 0.17 tons of rice in the production of cotton. whereas China has the lower opportunity cost, which is 2 tons of cotton in the production of rice. Therefore, Malaysia has the comparative advantage in the production of cotton, and China has the comparative advantage in the production of rice. Malaysia has to sacrifice only 0.17 tons of rice in order to produce 1 ton of cotton, while China has to forego 0.5 tons of rice. It is better for Malaysia to produce cotton since it has a lower opportunity cost in respect of cotton than China. In terms of rice, China has to give up 2 tons of cotton compared to Malaysia, which has to give up 6 tons of cotton. This means that China can produce rice at a lower opportunity cost. Term of trade. Term of trade refers to the rate at which goods are exchanged. If the average prices of exports and imports are obtained, the terms of trade can be measured as the ratio of export prices to import prices. So the calculation will be terms of trade equal average price of exports divided by average price of imports times 100. For example, 1 ton of rice for Malaysia is the cost of 6 tons of cotton, while for China, opportunity cost for 1 ton of rice is 4 tons of cotton. So the terms of trade is 1 rice equal 4 cotton. Balance of payment. Balance of payment is a statement of systematic records of all economic transactions between one country and the rest of the world during a given period of time. This is an example for Malaysian balance of payment. Protectionism policy. We have 6 tools. The first one is tariff. Tariff is a tax imposed by the government of imported goods. It can be 2 types of tariff. There are specific tariff, a fixed tariff imposed on a unit of imported goods, and also another one is ad valorem tariff. Is a tariff imposed on imported goods based on the value of the goods. Second, quotas. Quota is a legal limit of the number of units of a particular commodity that can be imported. For example, the Malaysian government decided to limit the import of television sets from Japan to 10,000 units. So, as soon as the quota is reached, no more television sets can be imported. The third one is embargoes. Embargoes is a law that bars trade with another country. Embargoes are the strongest limit on trade and are also known as direct control. An embargo may include a ban on goods from countries with different ideology. For example, Malaysia banned goods from Israel. Import license. The government can control the number of importing firms and the volume of imports through the requirement of import license. Number 5, exchange control. Exchange control is a control on the amount of money allowed to be brought into and out of a country. For example, a domestic producer in Malaysia needs to purchase goods from the US in US dollars. Restrictions on the amount of US dollars that can be used will reduce the ability of the domestic producer to import. Industry subsidies. The government provides subsidies to import competing domestic firms or domestic firms that produce export-based output. Reasons for protectionism. The first reason is national security argument. The argument is based on the assumption that a country should be self-sufficient in certain industries, such as the manufacture of aircraft and weapons. Second, infant industry argument. This argument is based on the assumption that infant or new industries should be protected from established foreign competitors until they have developed sufficient efficiency and economies of scale for them to compete on an equal basis. The third reason, anti-dumping argument. Dumping refers to the sale of goods abroad at a lower price or below the price charged in the local market. For example, if Thailand sells its rice in Malaysia at a lower price, meaning lower than Malaysia, this is referred to as dumping rice in Malaysia. This will worsen the situation for rice producers in Malaysia. The fourth reason, domestic employment argument. In domestic, producers cannot compete with foreign competitors. Then many domestic producers will leave the industry. This will lead to unemployment. To avoid high domestic unemployment, the country needs to practice protectionism by reducing imports and increasing exports. The last reason is low foreign wage argument. Countries need to impose trade restriction because wages in one country may be higher than that of another country. Trade restriction will overcome the trade of cheap labor. For example, the wages in Malaysia are higher than that of Indonesia, resulting in many Indonesians moving to Malaysia. This can lead to unemployment for Malaysians if the influx of people is not controlled. The end.